let's dovetail those together. To get to where you think we're going to get, is it just a smooth linear progression, or is it going to be either a jump condition or even more brutal, discontinuous? What's it going to be?
This is absolutely critical because before, when the Fed was just hiking rates, 25 basis points, they were looking around saying, how's the economy doing? Okay, we go another 25. And once we get through that process, that was all very smooth and gradual. But the challenge is that we have now, over the last few months, added a banking crisis and tighter credit conditions and a banking situation where banks are seeing much less demand for commercial real estate loans, much less demand for C&I loans. Those indicators are now at 2008 levels. Those things raise the risk, exactly as you're saying, Tom, that we may have that nonlinear slowdown over the coming quarters where tighter credit conditions may be accelerating the slowdown in the economy.
This is the key debate. Is this recession delayed or a recession interrupted? And we're looking at data. And is there anything to give us any indication ahead of it, or do we just have to wait and see what mystery box awaits us?
No, absolutely, because the challenge is if we threw 10 trillion at the economy, sucking that out again is going to take time. And how do I weigh that in my quantitative model purpose of the U.S. economy, where on the one hand, we had huge stimulus that's still stimulating, and at the same time, the Fed is trying to slow things down, and we have tighter credit conditions. So the market thought, and that's what the chart is showing today, that the recession would have come like 6 months ago. But now it's taking a longer time to take that 10 trillion out. But what we do know is that the Fed is very, very keen on getting inflation down from 5% to 2%. And as long as that's the case, the Fed will continue to step on the brakes. The Fed will continue to slow down earnings growth, and the Fed will continue to slow down hiring.